Hilton brings you new ways to stay. With experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Hi, everybody. Welcome to Talking Real Money, where we talk about money, yours, how you spend it, save it, invest it, protect it, deal with it every day of your life. And our goal is to help you become a better investor, to help you spend less, hopefully make more, do it better, easier, more logically, more simply, and within reason, safety-wise. And you are always invited to ask questions, to share comments. We like to hear what you have to say, even if we disagree, at 855-935-TALK, 855-935-8255. I'm Don McDonald. Tom is on vacation this weekend. He'll be back next week. What is next? How close are we to Christmas now? Let's see. Next week. Oh my gosh. Next week's the last show before Christmas, the last Saturday show. So only a couple of days you can call live, and this is one of them. It's every Saturday from noon to 2 Pacific on Como Radio. It's 3 to 5 Eastern for you guys listening all over the country or who are podcast listeners. 855-935-8255. And we try to help you buy the best stuff. We try to help you pick out great investments, the kind of investments that you can just sit back and let them run themselves. And we're not talking about actively managed funds. We don't believe in those. We believe in index products. But there is such a tremendous amount of really terrible advice floating around out there about investing. And I don't mean terrible in that they don't know what they're talking about. I mean, these are some very smart people. Very smart people. They're not dumb. I just don't understand why they make these suggestions, because they violate all the rules. I mean, there are some simple rules of investing, and these are things we talked about this in our interview with Robin Wigglesworth, who wrote the book Trillions. There has been a ton of academic research that shows that some very simple things help you create the best possible portfolio, and that's diversification, proper diversification, paying low fees, as low as you can pay and still get the kind of service and portfolio you need, and rebalancing regularly. Yet everybody still thinks there's some secret fund out there, and these headlines lead you to believe that, like this one in Forbes that says, move up your retirement by decades with this 3-fund portfolio. Now, I think that takes hyperbole to a whole new level. By decades? Wow, you better have a portfolio that's doing like 30% a year if you're going to beat just a regular balanced portfolio, 25 or 30. And what is it? Well, this comes from a gentleman by the name of Michael Foster, who's, again, very well-educated guy. Really is. But he's a picker. And he's suggesting closed-end funds. Now, closed-end funds are kind of tricky. They're mutual funds, but they're never letting in any new capital. So they trade like an ETF. They trade like a stock. And sometimes they trade for more than they're worth at a premium. And sometimes they trade for less than they're worth at a discount. So if you pay a premium for a closed-end fund and it goes back to just being normal, you can lose money just doing that. But he's all about dividends. This guy's all about dividends. Now, dividends are fine. But really, the bottom line is, what are these things making? And how much are they costing you to do it? And how much risk are they taking to do it? And the 3 funds he suggests, the 3 closed-end funds, one we've talked about many times. Its ticker symbol is USA. And that is the Liberty All-Star Equity Fund, and it pays a ridiculous dividend of about 10%. How do they do it? Well, they don't get a dividend. They just sell stuff and give you money. Their average annual return over the past 15 years. This is dividends plus any capital gains, 9.5%. Well, that's less than the S&P 500. And they do it for a mere 1.02% per year. Whoa, wait. 1.02% per year? If I get a really diversified portfolio, let's say I just get that dull, boring VT, that thing returned about, over 15 years, more than that. It doesn't have a 15-year track record. But what do they charge? They charge 0.08. And after the break, let me share two more with you.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Please call us at 855. Please call us. Please call me at 855-935-TALK, 855-935-8255. I'm Don McDonald. Tom's on vacation and talking about an article I read in Forbes entitled Move Up Your Retirement by Decades with this 3-fund portfolio by Michael Foster. And he talks about 3 closed-end funds. The first one was Liberty All-Star Equity, which actually has made less than the dividend it pays out, which is kind of magical. And because they pay out about a 10% dividend, but the stocks in their portfolio are Alphabet, Amazon, whatever Facebook's called now. And none of these pay big dividends. None of them. They're just paying out money, just paying out principal. The next one is a municipal bond closed-end fund. Tax-free, get this, about 4.5%. Now, right off the bat, there's got to be something wrong, right? How do you get a tax-free 4.5%? Well, you do it by having a lot of junk in the portfolio. Just under half of the portfolio is very low quality, and if you drop triple B in there, it's about 70% of the portfolio is lower quality bonds. And they have an expense ratio for a bond fund of 0.98, 1%. And finally, he picks a real estate investment trust, which is a trust of trusts. It's another closed-end fund. And what's the name of that one? I forgot. Cohen & Steers, Quality Income. And they have about a 6% yield, which isn't outrageous. But they charge 2.2% per year to run the fund, and it's a fund of REITs. They're not going out buying property. They're just buying REITs like Vanguard does for 0.12%. Now, both of the funds have done very well. One making over 30, the other making over 40. The Cohen & Steers has done better, but it also takes more risk in doing so. And this is the point. There's no magic. Risk and return are absolutely linked to each other. The higher the return on an investment, the more risky it is going to be. The higher the fees on a product, the more risk they have to take. It's simple, and it's absolute. Oh, there may be times when one does better than the other because it was in a better place at a better time. But higher returns require taking more risk, and higher fees require taking more risk. 855-935-TALK. That's our phone number here at Talking Real Money. And Sam, it's your turn. Welcome to the show.
Hi, Don, and thank you very much
for
what you do here. Hey, my question is, I've had my brothers for their kids set up custodial accounts. I work for a company that was very good and gave us lots of stock and options and whatever, and I've donated it to the children, and I want them to convert it to like the total market because it's at Fidelity.
Mm-hmm.
who is responsible for the taxes? Is the child or the parent who's the custodian? What if they do that?
Well, it
change it to the total market.
It depends. I mean, you can have, if a kid, you can file a return for a child, but the the ultimate responsibility is going to fall on the parents, of course.
Okay.
How much? Well, but here's the deal.
Brother has a. Go ahead.
How old are the children?
Oh, some are 5, some are 2, some are in their teens. Yes.
And how big is the capital gain going to be?
A lot.
A lot. Okay, because there is a limit. I'm trying to remember what it is. Kids, you don't have to report under a certain amount. I gotta go to the IRS and actually look this up because I haven't talked about it in so long. It sounds like it sounds like the child will have to file a tax return, because they're gonna have more than I think it's 11,000. And don't quote me on that, but I'm pretty sure. So I'm pretty sure it's going to have to be on the child. The child is going to have to file a return for the year. I think this is the time. There are certain times in life when an accountant is an absolute necessity. And when you have huge capital gains, adult or child, it's probably time. Okay?
Okay. Well, I thank you very, very much.
You're very welcome. Thanks.
I love your show.
Thank you.
Thank you
Appreciate
again.
the call.
Merry
Christmas to you too. That one hasn't come up in a while, but I'm trying to remember what the number was. I think it was 11,000. I'm pulling it out of my ear. Brian, it's your turn. Welcome to the show.
Good afternoon, Don.
Hi, Brian. What's up?
I am one of those people that is being retiring early, but not necessarily by choice, at age 61.
Mm-hmm.
Had intended to work until I was 67, but there's a medical issue.
Okay.
My question is, I have a mortgage for $250,000 at 2.99%.
Okay.
And I have $212,000 in a taxable account, comprised of mostly of the Ginnie Mae fund at Vanguard, along with some of the 25 target date fund.
Okay.
Should I take that taxable account and pay down the mortgage?
Mm-mm.
And then
No.
I'll have a mortgage for about 3 years?
No, for a couple of reasons. One, you said that you're retiring early because of a health issue. Well, when you have health issues, liquidity is critical. You need liquidity. You need the ability to get at that money quickly in case something happens with your health, and you got to have a bunch of money very quickly for some sort of a care situation or whatever it might be. So the other thing is that 2.99% interest is far less than you are likely to make in a target date fund. Far less. Even the most conservatives target date fund long term should not make less than 3% per year on average over a 5 or 10 year period. It just shouldn't, unless we have the worst market ever. And even in that case, a 2025 target date is very conservative. I almost always vote for liquidity over paying down a mortgage because it gives you greater flexibility. Should other things happen that you didn't anticipate, just like this. You had to retire early because of something you didn't anticipate. So I like keeping your powder dry and your options open. So, no, I would not do it. Thanks for the call. I appreciate it very much. We'll be back, 855-935-TALK.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Life is filled with financial dilemmas and issues and problems and concerns, and you need someplace you can turn. We will be that place for you. You can call us at 855-935-TALK anytime. I'm Don McDonald. Tom Cox on vacation in Mexico, enjoying the sun, which we kind of have in Florida too. 855-935-8255. Eric, you're up next. Welcome to the show.
Love the show. Love
Thank
what you
you.
guys are doing. You make investing fun.
Thank you very much.
So appreciate that. So I have a kind of a unique question. And this is really probably for the audience that is more conservative like myself and went and did your test online and rate super low, or excuse me, like a 50.
That's pretty conservative. Yeah.
Yes.
That's
yes.
risk
And this
averse.
is where I want your expertise.
Okay.
Yes, very risky. And I've done like real estate, you get the income, you get the capital appreciation, the tax appreciation, all that stuff. But now it's so hard to find property and wanting to be in the market, not trying to get into the prediction business with the market. But what are your thoughts? And I hear this on your show a lot where people have a decent lump sum of money and they don't want to lose principal. They want they want it all and, no risk, of course. But what about this idea
that's human nature.
You ladder seat.
I want the same thing. I want the same thing. I want to make 10% per year, and I don't want any risk.
Exactly. So here's for us risk-averse people, which seems like a lot of us, that you'd said on your show, I think you guys said there's trillions on the sideline just sitting in banks and not doing anything. So with that idea in mind, what if you're to ladder CDs, maybe bonds, and take all that income and invest it in the market with maybe a Vanguard VT, a little more risk, but not really affecting your principal, and maybe run those ladder CDs bonds out longer and your principal protected for the most part, and then run that for 10 years. Obviously, it's not going to be as good as if you put your $1 million or whatever you have on the sideline.
Right.
What are your thoughts with that?
Here's the problem with doing anything like this is it still is a form of market timing, because you're better off in than out because of the fact of just the overall growth of the economy. You're better off being in than out. I would rather see you start off with a portfolio that was 20% in a VT and 80% in a BND or a ladder of CDs if that's your preference. But I would not want to see you totally out of the market to begin. Now, as your fixed income money grows, you're talking about basically the same thing, but starting off in the market rather than out. Because if you start off out, you're saying, I think the market's going to go down. I'm betting it's going to go down, and so I'm going to buy it slowly. Well, people have been betting since 2009 that the market was going to go down a bunch and do it for a while. They've been consistently wrong. You could be wrong for the next 2 or 3 years and you're going to kick yourself. However, if you have a portfolio that's 80% fixed income, whether it's a laddered CD or the Vanguard Total Bond Index or a short intermediate treasury, you see, you're not looking at the money you're going to make or not make from the bonds. The bonds are just there to keep you psychologically grounded, because you need to look at your portfolio as one entity and go, oh, well, the market's way down, but look, I'm only down 5%.
Right.
I'm not going to panic because I'm only down 5% for my whole portfolio, even though your stock portion may be down 50 because you only have a little bit there. Your whole, ever, the biggest mistake we all make as investors is looking at the pieces and parts. Never look at the pieces. When I go to my Schwab statement, the only line I ever look at is the top one on my electronic statement that says how much money I have. That's all, because that's the number that matters. The rest of them are details, extraneous. So I would rather see you start 20-80, 30-70. If you're a 50, you could even probably go 30-70. But start 20-80. Say you're more conservative than that because you sound more conservative than that. But at least get started with money in the market. And remember, if you're in VT, you're in the U.S. and international, so you have more diversification.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Cloudy skies, seeing some sun breaks right now, 47 in Seattle.
Reality radio for a really great future. We're talking real money.
And I forgot to turn my mic on. And we still have lots of time. Lots of time. And lines open at 855-935-TALK. I talked, and then I realized I wasn't hearing me. And then I looked over, and my red button wasn't on. So I turned it on. That was my fault. 855-935-TALK. That's the number, 855-935-8255, to talk real money on, interestingly enough, Talking Real Money. Barbara, you're up. Welcome to Talking Real Money.
Hello, Don.
Hi, Barbara.
Please be patient with me because I don't understand a lot about investing. Not
Sure.
much at all.
No. I
recommend-
like helping people who don't understand it.
That's your business.
That's my business.
Okay. Do you recommend ETFs?
I like ETFs. Yes, ma'am. I do. I think the concept is sound. I, of course, being a big coward, don't like new products initially, and so I'm very skeptical. I'm a skeptic. I think Wall Street invents more bad stuff than it does good stuff. But in the case of ETFs, the more I've learned over the years, the more I like them. I think they're sound products constructs. The tax advantages are terrific, and as long as you're dealing with well-diversified index ETFs, they trade inexpensively. They have low fees. It's just really they're a good vehicle. Yeah. So generally, I like them. But now the devil gets into the details. Do I hate some? Yeah. What's your situation?
I'm older and I'm conservative.
Mm-hmm.
And is this something that would be good for an older person who's conservative?
Okay. This is one of the issues, and this is not you. This is the system. The system has convinced all of us, and I was as guilty of this as anyone, that we want to look for the right product. But we don't. Mm-hmm. We're starting at the end. The last thing you do when you are wanting to invest is consider the product into which you'll put your money. What you have to do is figure out what you want your money to do for you first. So the question starts with, one, how much do you have to invest?
Mm-hmm.
Then, what do I want that money to do for me? How much, what do I need it to do? What do I need this money to either generate an income or provide for some future need or whatever it might be? What do I need it to do? And then how much risk am I willing to take to get there?
Okay.
And finally, how much risk do I actually need to take to get there?
Oh.
Because they're two different things. You may say, okay, I have $1 million and I need it to generate $80,000 of income in 5 years. Well, that's not going to be easy to pull off. And I don't want to take any risk. Well, you're going to have to take risk or you're going to have to lower the income you want.
Right.
But the product is not that important because when it comes right down to it, you're only going to be dealing with a very few products. We make this so product-centric, and that's because Wall Street does, because they're always inventing new products. But really, the products that you will use will be very limited. That's why on our website, we just have 3 kinds of funds that we suggest. There's a U.S. equity fund, an international equity fund, and a fixed income fund, either in a fund or in an ETF. Because once you know that, then you figure out your ratio. Okay, I am a moderate risk taker. And when you determine that the right portfolio for you is 50% stocks, 50% bonds, because you cannot stand a year where you lose any more than about 25%. You just can't you couldn't tolerate it. So that would mean you take half of your stock money and you put it in a U.S. index ETF. The other half of your stock money in an international index ETF, and then the other half of the total sum into a intermediate term, high quality bond ETF. That's it. So you see, the product is easy. It's the other stuff that's hard. So you got to figure out what you need, what you want it to do for you. And then go to TalkingRealMoney.com. Go to TalkingRealMoney.com, too, and take the risk quiz. Barbara, thanks for the call. 855-935-TALK. Give me a call right now.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Yeah, you can call us 24 hours a day, 7 days a week at 855-935-TALK, 855-935-8255. I think I'm a pretty smart person. People have told me that. You know, when I was a kid, I was, always in the gifted stuff and all. I'm a smart person. I've been talking about money on the radio now for, oh my gosh, 33 years, something like that. It's like, I think I know what I'm talking about most of the time. I'm not always right, but I try. Well, I was reading that Coinbase article. I read it in the previous hour or the previous day's podcast, and about cryptocurrencies and how they're so misunderstood. Well, there was another article that just caught my attention. So during the breaks, I was reading it because the article, it's entitled 5 Ways to Earn Passive Income. Oh, income's nice. From NFTs. You know what an NFT is? Some of you do. Most of you probably don't. It is a non-fungible token. What does that mean? I'm not even going to try. I don't have time. Non-fungible tokens. It's part of the crypto industry. And it's where you can buy things like the Rainbow Cat video for millions of dollars. We did it on one of our recent podcasts, talked a little bit about them. You can see some pictures of NFTs on there. But this article talks about how you can, see, it's getting more complicated. So you don't just buy non-fungible tokens anymore. No. You can create passive income by renting out your NFT. Wait a minute. So you got something that doesn't really exist, and you can rent it to someone else for real money. Do you take only crypto, or do you take like dollars for that? But there was one of the things, and it's not that any of these are good ideas. I am not sharing this because I think you should do any of this, because it all sounds silly to me. It's what the reason I'm reading this is because of a paragraph, or actually 2 paragraphs like this. Now, clear your mind. See if you can understand this. This is an article in a publication called CoinDesk. The suggestion is to earn income that you adopt NFT-powered yield farming. Now, of course, we all know what that is, right? Right, here's what it is. Yeah. Mm-hmm. Because, I'm sorry, you can hardly read this with a straight face. Because NFTs, non-fungible tokens, are fast becoming a core component of AMMs. I'll define that for you. Automated market makers. Users can now farm for yields using NFT-powered products. Yield farming refers to the method of leveraging multiple DeFi protocols in order to generate the highest possible yield with the digital assets you have. And then they gave an example above. From the example above, the LP NFT tokens issued as liquidity provider tokens on Uniswap can further be used as collateral or staked on other protocols to earn additional yields. Think of it as earning a yield on top of another yield-generating protocol. And I guess that's because Uniswap v3, this is another direct quote, Uniswap v3, the automated market maker, will issue an ERC 721 token, which is also known as an LP NFT, that details your share of the total amount locked in the pool. Other information etched into the NFT is the token pair you deposited, the token symbols, and the pool's address. Doesn't it make you just want to rush right out and buy some NFTs? Non-fungible tokens. Oh, the last paragraph. This is the best advice of the whole article. I don't even know what the rest of it meant. No idea what any of that meant except NFT. And I'm not even sure what those are yet, except I know there's a rainbow cat. Final paragraph of the article. This was by an Andrei Serginkov? I don't know. Note, however, that NFTs and the underlying smart contract technology is still relatively new. As such, many of the applications providing the opportunities highlighted in this article are in their formative stage. In light of this, it is advisable to carry out due diligence and understand the risks involved before adopting any of the above listed strategies. Your due diligence should probably be a 4-year course on what the heck are they talking about. 855-935-TALK is our phone number. You can also send questions in at talkingrealmoney.com. You can call them in, but you can send them in. You can speak them in on talkingrealmoney.com, and then we'll answer them on shows or podcasts like this.
Hello, Tom and Don. Hi. I was going over the Schwab Market Track All Equity Portfolio, SWEGX. I got a question for you. It's almost mirrors the Paul Merriman 10 fund portfolio to a T, in fact, for Schwab funds. A little pricey at 0.53. My question to you guys, is this an appropriate long-term investment, mixing it with a bond fund? And if not, maybe you guys could make a suggestion of another fund that would be just as appropriate. Thanks, guys. I really appreciate what you guys do. Take it easy. My name's Andrew.
Thanks, Andrew. I'm glad you called because I've never heard of this fund. So I looked it up. And you're right. It does look a lot like Paul's very diversified portfolio. We've got U.S. large growth, U.S. large value, international large growth, international large value, international or U.S. small value, emerging markets. It's really pretty similar. Not identical, but it's pretty darn similar. But the thing is, it's a fund of index funds. But here's what gives me just the slightest concern. This is my hesitation. It's a fund of index funds, but it's an actively managed fund of index funds, thus the higher expense ratio, because the portfolio itself, the index funds themselves, probably cost in total 15 or 20 basis points. So they're tacking on an extra 30 basis points or so to pay for the management, where they're trying to reallocate the portfolio. And it's heavy S&P 500, which really doesn't make it like Paul's. Is it okay? I guess it's actively managed. It's a little expensive. I don't know that you need to make it that complicated. What you could probably do is, and this is a suggestion of Paul. Paul has often suggested just getting a target date fund that's appropriate for your age and risk tolerance, and then adding to that a small cap value fund. That's 2 funds. And I can't imagine it's going to be much different. And it is going to be certainly less expensive. Thanks for the calls. Thanks for the questions. Thanks for being there. We're going to take a break. We'll be right back. 855-935-TALK is the number, 24/7.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And we've got a big deal coming up. Our first live event since COVID, literally since COVID. In February next year, we're holding a both in-person and virtual Retire Meet at the Meydenbauer Center in Bellevue and, of course, online. And right now, if you get your tickets before the end of the year, you save $5 a person, and it includes all kinds of stuff. Breakfast, great lunch, serve a great lunch. Plus lots of great people. Apollo Lupescu from Dimensional Funds, Herb Weisbaum, the Consumer Man, Tom, me, lots of other people talking about all kinds of important retirement stuff. Go get your tickets now at retiremeet.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.